Ron Parks here, and welcome back to the channel. I want to talk about inflation and how it really affects you. And I want to give you an overview and a primer, so at the end of this segment, you'll really understand the impacts that inflation has on your wealth. Well, the inflation rate demonstrates the health of a country's economy. It's a measurement tool used by a country's central bank, economists, and governmental officials to gauge whether action is needed to keep an economy healthy. That's when businesses are producing, consumers are spending, and supply and demand are as close to equilibrium as possible. A healthy rate of inflation is good for both consumers and for businesses. Now, during deflation, when prices drop, consumers hold on to their cash because the goods that they buy will be cheaper tomorrow. Businesses lose money, cutting costs by reducing pay or employment. Now, that happened during the subprime housing crisis in the late 90s. And in galloping inflation, consumers spend now before prices rise tomorrow. That artificially increases demand. And businesses raise prices because they can, as inflation spirals out of control. Now, when inflation is steady at around 2%, the economy is more or less as stable as it can get. Consumers are buying what businesses are selling. And so to understand where inflation is today, we need to go over a brief summary of the business cycle. Because the business cycle runs in 4 phases. The first phase is the expansion phase. This is when economic growth is positive, with a healthy 2% rate of inflation, or close to that. Now, the Federal Reserve, which is called the Fed, considers this an acceptable rate of inflation. On August 27, 2020, the Fed announced that it would allow a target inflation rate of more than 2% if that will help ensure maximum employment. It still seeks a 2% inflation over time, but is willing to allow a higher rate if inflation has been low for a while. Now, number 2, as the economy expands past the 3% rate of growth, it can create an asset bubble. That's when the market value of an asset increases faster than its underlying real value. For example, real estate. When we had a run-up of real estate prices, it was really not in line with the true value of that real estate, and we had a crash. Okay, number 2, the second phase. The second phase of the cycle is known as the peak. This is the time when expansion ends and contraction begins. As the market resists any higher prices, a decline begins, and this is the beginning of the third or contraction phase. The growth rate turns negative if it lasts long enough, which can create a recession. And you've seen that. We have cycles of recessions where production output is going down and prices are going up, and therefore we have a recession. Now, during a recession, deflation can occur. Well, that's a decrease in the prices of goods and services. It can often be more dangerous than inflation. And as the economy continues its downward trend, it reaches the lowest level possible for the circumstances. This trough is the 4th phase, when contraction ends and economic expansion begins. The rate of inflation begins to increase again, and the cycle repeats itself. Now, during recessions and troughs, the Fed uses monetary policy to control inflation, deflation, and disinflation. Now, here are a few key takeaways. The U.S. inflation rate by year reflects how much prices change year over year. Now, year-over-year inflation rates give a clear picture of price changes. The Federal Reserve uses monetary policy to achieve its target rate of 2% inflation. If we look back to 2020, the U.S. economy was in great health. Unemployment was low, the stock market was very high. Everything seemed to be going great. Then the coronavirus pandemic hit us all. Millions of people lost their jobs. Companies closed, the economy shrank, and it was a very scary time. And with the economy at risk of completely deflating, the cavalry rushed in to try to solve this problem. The Federal Reserve pumped money in. The White House and Congress offered trillions of dollars to help families and companies. Business started to reopen, hiring workers again. And then at the beginning of 2021, it looked like all these things had saved the day. The country, everyone thought, was back on track. Millions of Americans got vaccinated and felt safe. Children were back in school. Sports leagues were reopening. The scariest days of the pandemic appeared to be behind us. So the economy would just resume growing in its normal way, we all thought. Well, it didn't. The economy, it turned out, was actually growing too fast. People were spending more money than anyone had expected, buying furniture, cars, houses, and groceries. It was hard to supply all the things people wanted, to buy as fast as they wanted to buy. So prices went up because there was a great demand and a shortage of supply. And when prices go up, and they go up very fast and very high, people stop spending money because they just think it's too expensive. But this time, something strange happened. People bought more and more and more. And this made prices go even higher. Now, the Federal Reserve is now trying to help get this inflation under control. It just started raising interest rates, which is meant to let a little bit of air out of our green balloon. Not too much air, they hope, but just enough to bring things into stability. They actually just want to bring the balloon, the economy back to earth. But it's not so simple. There are new dangers lurking. Russia's invasion of Ukraine has created an entirely new crisis that is already pushing some prices even higher than they've ever been. The cost of a barrel of oil is over $100, and you can't really buy gas for probably less than $5 a gallon at the gas pump. So what happens next? Well, we really aren't sure. The economy is being pulled in many, many different directions. Raising interest rates should slow inflation a bit, but these are not normal times. There's a war in Europe, and coronavirus surges are keeping the pandemic going. And if the Federal Reserve raises rates too much, it could be very bad for the economy. But if the Federal Reserve doesn't raise them enough, inflation will drive prices to greater heights. And that's a lot of pressure on families struggling to pay the bills. Now, the hope in all of this is to get the balance just right, to keep the balloon, our economy, in a very safe place. Now, I've summarized a little bit about what inflation is and how it actually impacts you. So I hope this gives you some overview of why inflation is so important to your wallet and to your family's wealth. So please watch for the next episode. If you really enjoy this, I would appreciate you smashing the like button and subscribing. And until next time.